morning, Trinidad and Tobago, and welcome once again to the Bourse Report. On the lips of every national is the question of what is the national budget going to bring this year. And it's just about 1 week away for the national budget, and I thought that we would have a discussion very briefly on what one can expect for investors in terms of how is the budget likely to affect their investment initiatives. Well, first of all, the main driver that has been discussed is the need for economic growth. As you know, over the past 3 years, economic growth has been non-existent. In fact, it has been negative over the past 3 years, as you would see from the graph, where you've had a situation where in 2009, negative 3.3%, fairly flat in 2010, and down 1.4% in 2011. What is it going to be in the 2011-2012 year? We'll hear in the budget. But the outlook is for very muted growth at best of 1%. What does this mean for an investor? Well, in fact, what it means is that one could expect that this will drive into corporate earnings also being muted. And what does that mean with corporate earnings? Share values will remain somewhat stunted as we look ahead. The outlook for growth is heavily dependent on what is going to happen in what I would consider three sectors: the energy sector, the agriculture sector, and the financial service or capital markets sector. When you look at the graph there, what you would see is that energy sector still constitutes some 45% of GDP. The capital markets or financial service, just about 11%. And trailing way behind is the agricultural sector, which is about 0.6% of GDP. Yet still, if we can drive the agricultural sector, we are going to get a higher employment benefit. In the energy sector, which still only employs about 3% of nationals, and in the capital markets, the banking sector and insurance sector still remain the main drivers. What has happened in the past year is that in terms of prices, what we have benefited from prices in oil and energy. And this has helped to minimize the extent of the deficit. In oil, as you would see in your graph, the average price was $95.71 as opposed to the budgeted figure of $75. And this has helped in terms of ameliorating the budget deficit. In gas, the netback price was expected to be $2.75, and my informal discussions suggest that for the first 6 months of the fiscal year, the netback gas price was actually higher at $2.91 MMBTU. But volumes have not been growing in that sector, and that is the challenge. What we can expect to see and look for are initiatives downstream. SABIC Sinopec is one of them. The Carousel project is no longer on stream, as I understand it. What's happening with the 80 million barrels of oil that has been recently discovered and the need to accelerate production in that particular area? The bid rounds, 5 out of 6, have had more than one bidder, and this augurs well, but will not feed into the economy in the early rounds. So we talked about equity. Let's talk quickly about debt. Government's fiscal position continues to be in deficit, and what you will see is that the expected $7.6 billion in deficit in 2000 and this last budget year. Let's see how it turns out because of the increased prices in terms of oil and gas, whether it's going to be 7.6 or less. The fact is, though, that as we look forward, this deficit continues to provide fiscal injections to the system, and interest rates will continue to be low as we look to the year ahead. So don't expect any significant impact or increase for investors in your interest rates. And that's the story with regard to interest rates, whether short or long. We have said before, you may need to go out longer. But of course, inflation is a big issue, and inflation continues to be in double digit. So if the drive is for food, you can find higher employment in that sector. You can find that the food inflation, which is the key to the equation, can be brought to heel somewhat. And those are some of the issues that you will have to address. Again, very quickly, the P multiples in the equity sector are already high, and if we continue to have muted economic growth, it will impact earnings in that sector, and one can see a slowdown in the increases in the capital market valuation, which has been positive for the last 3 years. On terms of interest rates, on the debt side, interest rates will continue to be low, so investors have to look for different and better ways to improve on their yields. Have yourself a wonderful investment week. Look for us on page 10 of the Express with regard to our recommendations and with regard to the prices of the funds which we manage, mutual funds, the Save Invest range of funds. This is Subhash Ramkilawan for the Bourse Report.